If someone asked you to name the most boring financial company in America, you might pick a bank that has been quietly managing money for the ultra-wealthy since 1889. A bank that requires a minimum of $75 million to open a wealth management relationship. A bank so focused on being reliable that its marketing sounds like it was written by a trust attorney.
And then that bank posts a first quarter earnings beat of 17%. EPS of $2.71 against a $2.32 estimate, the largest beat in years. Net interest income hitting a new quarterly record. Management raising guidance the same day they reported.
That is Northern Trust. And once you dig into why they just had their best quarter in recent memory, the boring label starts to look like a compliment, because this company has been quietly building operating leverage in one of the most defensible business models on Wall Street.
Let's get into it.
Northern Trust was founded in Chicago in 1889 by Byron Lyman Smith, who wanted to build a bank that served wealthy clients and institutions with a level of service that mass-market banking couldn't provide. The name has not changed. The strategy has barely changed either. 137 years later, Northern Trust still serves the same two clients, wealthy families and large institutions, and refuses to compete on price.
Today, the company operates through two primary segments. Asset servicing provides custody, fund administration, investment operations outsourcing, and securities lending to institutional clients around the world. Corporate pension funds, endowments, foundations, sovereign wealth funds, and fund managers. At the end of Q1 2026, asset servicing clients had $18.6 trillion in assets under custody with Northern Trust. That is not a typo.
$18.6 trillion. To give you a sense of the scale, that is roughly equivalent to the entire GDP of the United States sitting in one custodian's systems.
The second segment is wealth management, and this is where Northern Trust is genuinely differentiated. The typical minimum relationship is $75 million. They serve ultra-high net worth families, executives, business owners, and professionals across 24 U.S. states and 22 international offices. At the end of Q1, wealth management AUM was $498 billion.
The total AUM across both segments is $1.78 trillion, up 11% year over year. And that AUM is not in passive index funds. It's actively managed, generating higher fee rates than index alternatives. The fee revenue from trust and investment services alone came in at $1.34 billion in Q1.
The business model is fundamentally built on two revenue engines: fees that rise with market levels and assets, and net interest income that reflects the interest rate environment. When both tailwinds are blowing, rising markets and a constructive rate environment, Northern Trust's operating leverage kicks in hard.
That's exactly what happened in Q1 2026. Running Northern Trust is Mike O'Grady, who became chairman, president, and CEO in January 2019. He joined the company in 2011 as CFO, coming from nearly 2 decades at Bank of America Merrill Lynch, where he was a managing director in investment banking.
His background matters because it explains his priorities. O'Grady came from the institutional capital markets world. He understands how large institutions think about custody, risk, and counterparty relationships. That context shaped the asset servicing growth strategy and the healthcare initiative he launched in recent years.
Under O'Grady, the company has expanded into healthcare system custody, 4 new mandates just in Q1 2026, and has been on a wealth management producer hiring push, targeting 7 to 9% growth in wealth advisors by year-end. Those are organic growth moves you make when you're confident in the platform.
Wall Street's view on O'Grady shifted meaningfully in April. Goldman Sachs had maintained a sell rating on Northern Trust for months, not because the business was bad, but because they saw better risk-reward elsewhere in financials. When they upgraded to neutral this month, they cited improved management credibility on NII guidance as a driver. That's a meaningful concession from a house that had been skeptical.
Lana, the numbers first. This was a blowout quarter.
It was. Total revenue on an FTE basis came in at $2.21 billion, beating the $2.1125 billion estimate by $85 million, or 4% above consensus. That's a clean, broad-based top-line beat. EPS of $2.71 beat the $2.32 estimate by 39 cents. That's a 16.8% beat, the largest in recent quarters for Northern Trust.
Break down the revenue drivers.
Two things drove it. Net interest income, NII, came in at $661.6 million, up 15% year over year and up 1% sequentially. That's a new quarterly record. Trust, investment, and other servicing fees came in at $1.34 billion, up 11% year over year. Combined, those two lines alone tell you this was a broad-based beat, not a one-line wonder.
What about the profitability picture?
Pre-tax margin was 32%. That's up roughly 500 basis points year over year. The company's medium target is 33% pre-tax margin. They are 1 percentage point away. Return on common equity for the quarter was 17.4%, which is at the upper end of their medium-term target range. Net income for the quarter was $525.5 million.
Walk me through the valuation.
At a stock price of roughly $165 and $90 following the earnings reaction, Northern Trust trades at about 15.3 times forward earnings using the full year 2026 consensus EPS estimate. Price to book is 2.29 times. For custodian banks, PB is the primary valuation lens. You want to know what the market pays for each dollar of book value, because book value reflects the tangible asset base of the business.
How does that compare to where the stock normally trades?
Northern Trust has historically traded in the 1.5 to 2.5 times book range. The current 2.29 times is in the upper half of that range, reflecting the improved earnings outlook, but it's not stretched to the point of recklessness.
Balance sheet.
Total assets are approximately $161.9 billion. This is a large bank, primarily because of client deposits and custodied assets. The CET1 ratio, which is the core regulatory capital measure, came in at 12.0%, down 60 basis points sequentially as risk-weighted assets increased. That's worth watching. 12% is well above regulatory minimums, but the sequential decline bears monitoring.
Cash and debt position.
Northern Trust carries $6.3 billion in cash against $2.9 billion in total debt, so the company is in a net cash position by about $3.5 billion. For a custodian bank, this is somewhat unusual and reflects the conservative capital management culture.
Dividend and buybacks.
Annual dividend of $3.20 per share, yielding about 1.9% at current prices. Payout ratio is 37%, conservative. In Q1 alone, the company repurchased $359 million of stock, reducing share count 5% year over year. Both programs are well covered by earnings and free cash flow.
Overall financial health.
Overall, Northern Trust's financial health is strong. The Q1 beat was broad-based, NII guidance was raised, pre-tax margins are within 1 point of the medium-term target, and the balance sheet is well capitalized. The primary financial risk is the stock's valuation above consensus price targets. It now has to deliver to hold current levels.
What's the analyst consensus on Northern Trust?
The official consensus is hold. Of 14 analysts tracked, 4 rate it buy, 8 rate it hold, and 2 rate it sell. The average price target is $154, and here is the notable dynamic. The stock is trading at roughly $165 right now, which means the stock has run past the average analyst price target.
That is an unusual situation.
It is. When a stock trades above the average sell-side price target immediately after earnings, it means the market is pricing in more optimism than the analyst consensus reflects. Either the targets get upgraded in the coming weeks as analysts revise their models, or the stock retraces toward consensus. This is one of the most important things to watch in the coming month.
Recent analyst actions.
2 notable upgrades in April. BMO Capital Markets moved from market perform to outperform with a $168 price target. They cited management focus on higher margin wealth and asset management and a sharpened strategic direction. Goldman Sachs moved from sell to neutral, raising their target from 148 to 151, citing the improved NII trajectory. Goldman going from sell to neutral is meaningful given they had been one of the more skeptical voices on Northern Trust.
And the remaining ratings.
RBC Capital maintains outperform. TD Cowen maintains buy. Morgan Stanley remains at underweight, which is their most bearish read. Evercore ISI maintains in line. the upgrade cycle has not fully arrived. Most of the street is still waiting to see 1 or 2 more quarters of margin expansion before moving more constructively.
Let me build the bull case. First, the NII guidance raise. Management upgraded their full-year NII outlook from low to mid-single-digit growth to mid to high single-digit growth. That is not a trivial revision. NII at an annualized run rate of $2.6 billion means each percentage point of growth adds $26 million to the top line.
And the bear case on NII is the mirror image. Northern Trust's net interest income is directly dependent on the rate environment. If the Federal Reserve cuts rates faster than the market expects, NII compresses. The 15% year-over-year NII growth in Q1 reflects rate levels that may not persist through 2026. Every 25 basis points of Fed cuts can shave tens of millions off the NII run rate.
Bull 2. Operating leverage. The company is 1 percentage point away from its 33% pre-tax margin target. Once they cross that threshold, and assuming mid-single-digit revenue growth continues, the incremental profitability on each new dollar of revenue is significant. That's the compounding flywheel of a business with high fixed costs and growing revenue.
Bear 2. Valuation above consensus. The stock at $165 has already priced in a lot of the good news. The average analyst sees $154 as fair value, 7% below where the stock is trading right now. If 1 or 2 quarters don't deliver on the operating leverage story, the stock could retrace meaningfully. There is less margin for error at current prices than there was 3 months ago.
Bull 3. Institutional custody stickiness. When a large pension fund or sovereign wealth fund gives Northern Trust their custody mandate, they don't move that relationship for decades. The switching cost, operational complexity, legal documentation, risk is enormous. The $18.6 trillion in AUC is a moat measured in institutional inertia as much as product quality.
Bear 3. Competition from the megabanks. JP Morgan and Goldman Sachs have been aggressively building out their ultra-high net worth wealth units. They have deeper product breadth, global investment banking access, and the ability to bundle lending with wealth services in ways that pure-play wealth managers like Northern Trust can't easily replicate. The wealth market is not static.
How does Northern Trust stack up against its custodian bank peers?
The 2 direct comparables are Bank of New York Mellon and State Street. Both are custody-focused financial institutions with significant institutional client bases.
Start with BNY Mellon.
BNY Mellon is the largest custodian bank in the world, over $50 trillion in AUC. They also posted strong Q1 2026 results, with revenue up 13.8% year-over-year, confirming that the custody bank sector is benefiting from broadly similar tailwinds. BNY trades at about 16.2 times earnings and 2.23 times book, both very close to Northern Trust's metrics. The key difference is that BNY has less wealth management exposure, so it trades on the institutional servicing story almost exclusively.
State Street.
State Street is the more value-priced option in the group. At 1.36 times book versus Northern Trust's 2.29, State Street trades at a meaningful discount. That discount reflects lower wealth management revenue mix and questions about their long-term growth algorithm. Q1 2026 EPS growth at State Street was strong, but their multiples have lagged. If you believe the custody business is worth a premium, the gap between STT and NTRS on PB is striking.
What does Northern Trust's premium PB buy you that State Street doesn't offer?
The wealth management segment. Custody banks all trade around book value. Northern Trust trades at a premium because roughly a third of its revenue comes from ultra-high net worth wealth management, a higher margin, higher retention business that commands a premium over pure institutional custody. That is the structural valuation argument for NTRS over STT.
What is the options market saying about Northern Trust?
Options are trading at the 42nd IV percentile, moderately priced relative to the past year's range. The put-to-call ratio is 0.74, more calls outstanding than puts, a mild bullish lean. That is consistent with the stock having just broken to multi-year highs on a large earnings beat. Options traders are not rushing to buy protection.
Any notable positioning?
Call open interest is concentrated at the 165 and 170 strike prices. put open interest clusters at 155 and 150, roughly 6 to 10% below current prices. The options market is essentially saying the upside scenario is priced in, the downside protection is being placed at levels well below where the stock is trading. No unusual block trades were detected going into Q1 earnings.
What are insiders doing with Northern Trust shares?
The picture is largely neutral. SEC Form 4 filings from the past 90 days show minimal transaction activity, primarily routine director compensation awards in equity, where board members received scheduled stock grants as part of standard director pay packages. Multiple directors received awards in late March and early April, ranging from 22 to 268 shares.
No open market buying or selling from executives.
Correct. There are no significant open market purchases or discretionary sales from named executives. For a company of this size and compensation structure, that's fairly standard. Executive compensation is heavily equity-based and delivered through pre-scheduled programs that don't signal near-term conviction in either direction.
Let's rapid-fire the key risks and metrics to watch.
Interest rate risk first. Net interest income was up 15% year-over-year in Q1 because the rate environment is supportive. If the Fed cuts rates faster than the market expects, NII will compress. Watch the Fed funds rate trajectory and Northern Trust's NII guidance revisions every quarter.
Equity market sensitivity.
Fee revenue, $1.34 billion in Q1, is directly linked to AUM and AUC levels. A 10 to 15% equity market drawdown would mechanically reduce fee revenue by a similar percentage. This is not a unique risk to Northern Trust, but it is a headwind that arrives without warning.
Valuation maintenance.
The stock is trading above consensus price targets. That means the next quarter's results need to show continued pre-tax margin progression toward 33%. If the margin stalls, the stock gives back some of the Q1 pop. That's the single most important metric to track. Adjusted pre-tax margin, quarter over quarter, fell 60 basis points sequentially to 12.0%. Still well above regulatory minimums, but trending lower. If risk-weighted assets continue to grow faster than capital, the company may need to moderate buybacks or raise capital, which would be a negative catalyst.
The bottom line on Northern Trust. This is a 137-year-old custodian and wealth bank that just posted its best earnings quarter in years. The Q1 2026 beat, 17% on EPS, 4% on revenue, was broad-based, driven by record NII and strong fee growth. Management raised guidance the same day they reported, signaling genuine confidence.
The setup is compelling, but not without tension. The stock has run past the average analyst price target, meaning the optimism is already baked in at current prices. The NII tailwind is a function of a rate environment that could shift, and the pre-tax margin target of 33%, while close, still needs to be hit and held.
If you're watching one number from here, pre-tax margin, quarter over quarter, 32% in Q1, the target is 33%. Getting there and staying there is the proof point that the operating leverage thesis is real and durable. We'll leave you with a quote from Warren Buffett, which feels appropriate for a company that has been steadily compounding trust with its clients for 137 years. Buffett said, "It takes 20 years to build a reputation and 5 minutes to ruin it."
Northern Trust has been building that reputation since 1889. In asset management and wealth, reputation is the product.
That's going to do it for this episode of Charged Alpha, your S&P 500 encyclopedia. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
Until then,
I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.